Okay, we are live. Welcome to Boston Basic Income. I'm Alex Howlett. This week's topic is financial instability as it relates to basic income. So basic income at bottom is a simple solution to a simple problem. It solves the problem of how to provide money to consumers. Every large-scale economy has to provide consumers with money so they can buy stuff. And in the absence of basic income, we have to do something else. So the topic of financial instability isn't something that comes up a lot in most mainstream basic income discussions, but it's something that I often refer back to. And to understand where financial instability comes into the picture, we have to look at that something else. What is the thing we're doing instead of basic income that we're doing because we're not doing basic income? So the question is, what are the mechanisms that we're using today to get money into the hands of consumers? And a big part of the answer is that we use monetary policy to stimulate the private financial sector. We use expansionary monetary policy to make credit easier, so consumer purchasing power can be propped up by borrowing. Now, the problem with that is that if your purchasing power is depending on borrowing, and more debt builds up in the system, and my ability to pay depends on someone else's ability to pay me. My ability to make good on my debts depends on other people's debts to me. If someone defaults, if one link in the chain is broken, or if one domino falls, it has this cascade effect, after enough private debt builds up in the system. So that's kind of the instability occurring. Because we're not using basic income to get people their money directly, we are resorting to this unstable mechanism in its place. So there are many problems that are caused by the fact that the way we get people their money is broken. And I think basic income advocates often highlight, some of the obvious ones, like people are unnecessarily poor, they have to work more than they otherwise would, that kind of thing. But the financial instability one, I'm not going to say is more important, but it's very fundamental, and it's very tied to the core function of basic income, and the fact that we have to compensate by doing something else. So I'm actually presenting a paper on this next week at the North American Basic Income Guarantee Congress. And this discussion, I hope, is going to be a little bit of a preview of that. So we can ask the question, to what extent, so why are we doing this expansion of private credit? Do we have to? And the answer is that if we didn't, then you might not have this buildup of instability, but you'd have this loss of functionality in the economy, in the sense that consumers wouldn't have sufficient spending money, and you'd have deflation, and the currency would stop working properly, and all of that. So there are a few kind of intuitions that help us understand what's going on here that people often aren't thinking about. So when you think about money in the economy, a lot of times by default, people think about there being kind of like a certain amount of money in the economy that's just kind of circulating around. And this is maybe kind of a default assumption in some economic theories and models, where the idea is that people could just be producing for themselves, but then you make it easier for them to trade with each other, and that makes everyone better off, or something like that. The reality is that we live in a world where some people have specialized so much that they can produce way more than what they need. And then, is my audio breaking up for anyone else besides Bethany? I guess there's not much I can do about it.
Sorry to break your flow. I didn't know if it was just me, so I wanted to check.
Seems to be fine for Eddie. Yeah. Okay. All right. Perfect. So yeah, this idea that money is just out there, and it's kind of facilitating these trades, and everyone's kind of better off in that way. That's a nice simplification, and it does help us explain something. It helps us explain, the gains from trade and the efficiency that money brings as a medium of exchange, all of that kind of stuff. But what it leaves out is that, as I was kind of about to get at, is that some people are able to produce way more than they would ever consume, and then other people don't necessarily have access to the resources, or it's not efficient for them to, at the very least, produce for themselves. So the idea then isn't that everyone's a producer and they all trade their products with each other and that everyone's better off. It's that some people are more producers than consumers, and other people are more consumers than producers. And in order for the economy to work, you have to have a flow of money going from the consumers to producers in order to claim the flow of goods and services going in the opposite direction. So money is not just a standard medium of exchange in which everyone's kind of trading with each other at an equal level. It's the standard way that consumers claim the economy's output. So each dollar is a claim on a certain amount of stuff from the economy. And if you don't have an efficient distribution of money, an efficient distribution of access to the economy's output, then you're not going to have an efficient distribution of the product of the economy. You're not going to have an efficient distribution of the benefit that the economy is capable of providing, and maybe even to some extent, you're not going to have the full. You're not even going to have the economy producing its full output, because you need the incentives there. You need someone to want to buy the stuff in order to produce it. Otherwise, there's no point in producing something that nobody's going to buy. So basic income is an even distribution of money. So that's another key difference between the basic income distribution of money versus a distribution of purchasing power that's propped up by the financial sector, by easy monetary policy. Because if you are making credit easier, if you're making it easier to borrow, then the banking system will do whatever it does, and it's going to lend more to people who already have money, because they're the ones who are going to be able to pay it back. And then the lower interest rates drive up asset prices. So you're going to see this kind of skew where the people who need the money the most aren't necessarily going to benefit from the monetary stimulus. It'll be enough to prop up consumer prices to prevent deflation, because you're actually steepening the demand curve. And Bethany has been kind of bothering me to kind of have this diagram on hand whenever I talk about basic income. This is one of the key things that's in the back of my mind whenever I'm talking about basic income, is this figure right here. And you might recognize it because it's been my Twitter banner forever as well. So the idea is that if you're producers in the economy, so let me explain what these different curves are. So AD is aggregate demand, P bar is the price level, and then Q is the level of economic output. This is kind of the macro economy. And then Q bar is the productive capacity of the economy. So we're not talking productive capacity in the terms of output capacity. What's the maximum we could produce? Not capacity in terms of like, how much of our resources are we using? Like, that's not as important. Is it important that we're employing everyone or using up all our inputs to the machine? That's not as important as, are we getting the most benefit out of the machine? So as you can see in the figure on the left, we're producing below full output. We're producing at half of full output. And that's because if you look at the shaded area, that's the lower line there is the input price level. So that's not labeled, but you have this kind of rectangle, the shaded rectangle with the input price level at the bottom and the output price level at the top. So then the shaded rectangle is the amount of revenue or it's the amount of profit that the firms are getting in the economy. And you can see that if you, in the left diagram, if you moved along the aggregate demand curve to the right, you would, prices would decrease and quantities would increase, but the overall profit would go down because the rectangle is getting longer. So firms have an incentive not to increase quantities there because it's not profitable to do so in aggregate. So in order to make it profitable for firms to produce more, to bring it up to the full level of output in the economy, you have to change the slope of the aggregate demand curve. You have to make it so that firms don't lose, the prices don't go down as much when they increase quantities, then it can be profitable to produce more. So that's what I'm showing in the second diagram on the right, and that's the basic income allows us to get a flatter distribution. So basic income combined with monetary tightening. So instead of having this overly expansionary monetary policy, you have the basic income that flattens out the demand curve and allows us to bring the economy to full output. So we care about kind of maxing out the benefit that the economy can provide. And we also care about, people not being left behind. And basic income kind of addresses both of those things at the same time that it's addressing financial instability. So this is, anytime I start going on about price elasticity of demand, I often draw this diagram in the air, the slope of the demand curve. But this is a key thing for understanding basic income. And if you don't understand this, then you're not going to understand the problem that basic income is solving in the economy. So I guess.
Can I jump in here and just see if I can accurately summarize some of what this table represents for people who might have trouble following all the details? So is it kind of accurate to say that basically the steepness is reflecting the degree to which there are a smaller number of people who are willing to pay a lot for something versus a larger number of people who are willing to pay less for it? Like they can't pay over a certain amount, but there are a lot of them. It's kind of like representing the line. And so like the flatter it's getting, the more there are like a lot of people who can only pay like a bit for what you're making, and not as many people who are going to pay like a huge amount, at least relative to the other group of people. And so it becomes more and more profitable to produce more at a lower price, I guess, up until when you reach like the cost of production or whatever. Is that kind of like first of all, like a reasonable summary of what this line represents? Because I think it might be hard for people to, that helps me at least.
So the demand is a relationship between quantity and prices. Mm-hmm. If it's flatter, that means if you lower your price, your quantity is going to increase more than it would if the line were steeper.
Right. But I'm trying to get at an intuition for like what's happening there, for people who aren't used to thinking about this.
So in terms of the intuition, you can think of something like housing or healthcare or something like that, something people need as being very inelastic demand. So if you jack up the price, people are still going to pay the price because they have to, right? Because they need those things. So that's more the diagram on the left. That's a steeper aggregate demand curve. You can raise the price and still get the money from people, so you will. If the demand curve is flatter, that reflects more people being willing to buy higher quantities without the price having to move that much. So you can lower the price a little bit and get a lot more sales of your product.
Yeah, and so I guess that's, yes. And then just to tie it back into basic income, as you were doing before, if you're giving, let's imagine we're giving a certain amount of money to a whole bunch of people. Now you have a whole bunch of additional people with more money that can sort of buy, that presumably have a limit on that money though. So like as you increase the quantity and lower the price a bit, those people will buy more you'll be able to sell more because you'll be able to reach all these people that now have money, right?
Yeah, and really what it is, though, if you're looking at the aggregate level, these price levels are all going to be the same. If in both of these diagrams, if you decrease the quantity and increase the price, then that lowers the profit for everyone, for the producers, and the same thing in the other direction. So it has to be the case that the price level is going to equilibrate at that price level. And in order to, one of the key constraints on, the functioning of the economy and the functioning of money is that the price level has to be reasonably stable over time. the purchasing power of money has to be stable in order for money to function properly. So you can imagine doing other things with aggregate demand, like making it shallower without bumping it up or something like that. But then that would imply another price level. So there's really some constraints in terms of what you can do. You can make it steeper and you can make it flatter, but you can't do it in such a way that it would cause kind of the equilibrium price quantity combination to move the price level away from where the price level is, because then you'd have inflation or deflation or something like that.
Okay. So I guess let me try again, because that's a good point. Let me try again. So given that we're sticking at the same price level, which is represented by your P bar here, right?
Yeah.
Representing the same price. What you're doing is you're like giving a lot of people a basic income. You're adding a lot more people who are willing to buy it at that price, right? And so that's good. So like you're producing more then if you have that capacity at that price. Is the sort of result of that we're seeing here.
Yeah, and you're also reducing the number of people who would continue to buy it if you raised the price. So it goes in both directions, right?
And why are you doing the second thing with the basic income? Because that's counterintuitive.
Well, right. So what are you doing basic income instead of? You're doing it instead of easy monetary policy. So the easy monetary policy makes the demand curve steeper, and the basic income makes the demand curve flatter. So if you tighten monetary policy, that even on its own, it might flatten out demand curve because of marginal propensity to consume, that kind of thing. If you're, but it's you have the combination of these two things. You're introducing the basic income, and you're withdrawing, you're tightening credit conditions, you're tightening monetary policy. So those two things together flatten out the demand curve and push it out to the right.
And the idea there is that the monetary policy is basically giving more money to the people who already have a lot of money, and so then they're just willing to pay more and more for things, and that's kind of what steepens it up.
Yeah. It's if you don't have any money at all, monetary stimulus, it might help you indirectly in the sense that a business who can borrow, it might hire you and pay you in wages. But there are some people who just can't get jobs, and that's not going to change. Even during boom times, there are a lot of people who don't have jobs. So if you're expecting everyone to get their money from jobs, then some people are just going to be left behind. That's just kind of the way.
And I guess I should say, like, it's possible that other people get some money from the credit, from the easy credit, but the people who get the most money are the people who already have money, and so that's kind of like skewing it.
That's right.
Because then they'll just pay more and more.
It drives up asset prices, makes it easier for people who already have money to have access to more money, to borrow more. Yeah.
Right. And the intuition there, as many people probably already have, is that, like, even if credit is getting easier, the people who can most easily take advantage of it are the ones that can easily pay it back and so on, right? And already have money to use to leverage, get credit or whatever. And those people already are the ones who have more money and so on, right? So
that's right.
As we often talk about, it's like if you're already really need money, you often don't get easy access to anyone wanting to loan it to you because you might not pay back and so on.
Right. And another intuition for why we can't max out the economy's potential and just have it be poorly distributed, like, the economy is producing everything, but it's all going to rich people or something like that, is that rich people, they only want a certain amount of stuff. You're not going to, if only half the people have money, you're not going to produce enough food for everyone, and the rich people, are going to eat twice as much or something like that. So there are things that we're just not going to produce if the people who would otherwise want it don't have the money to buy it.
Yeah.
Yeah.
Let me say a couple other things before I forget. So one other thing I think you're very much thinking of that I'm just going to try to point out again is that, it's really about the distribution. It's about kind of who gets money relative to who. So basic income is flat. So it's really, really even. And so, whereas as we've said, these credit things, you may be giving a little bit of money even to everybody, but if you're giving a lot more to the wealthy people, it'll still have this effect, I think, right, on the demand curve, on the slope.
It'll, sorry, can you say that again?
Even if everybody got more money, but it was the wealthier people got, $100 and the poor people got 2 cents. And everything in between, would that still steepen the demand curve? Maybe I'm going off topic here.
So it depends, right? So if you give everyone just $100 on its own, rich people have a lower marginal propensity to consume, so that's going to increase their spending less than when you give to poor people. So that alone is going to help flatten out the aggregate demand curve. I think eventually you get to a point where If you're giving rich people so much more than the poor people, then you're overcoming that propensity to consume thing. So I think
presumably that's what's happening with current credit effects, I think.
In what sense?
Well, aren't you saying that the way that monetary policy currently props up the price level is through making credit easier, which ends up giving wealthier people more money, which makes them more willing to.
You have to have this.
That's overcoming the other issue.
Right. This is how we can have, inflation or inflationary pressure without the economy being at full output, is that you have this less elastic aggregate demand curve, and that props up the price level. And that's exactly, what we see on the left. That's the status quo, right? That's why I call it the status quo.
Yeah. And I guess it's interesting to what you pointed out, which is that like a basic income looks even, but it's actually like in consequence would probably be like equivalent to giving poorer people more money in terms of spending consequences relative to the wealthier people, because even though you're giving people the same amount, the poorer people spend it more. And so it kind of increases their demand more than it does the wealthier.
Yeah, that's exactly right. And this is why you can't just take money from rich people and give it to poor people, because the rich people weren't going to spend that money anyway. So there has to be the capacity in the economy to produce that stuff. And either the capacity is there or it isn't. If it's there, you can give the poor people the money and you didn't need to take the money from the rich people. If it isn't there, then taking money from the rich people isn't going to somehow allow you to give more money to the poor people.
Yeah, that's right. And Austin says it as well. He says if you give Bill Gates or Jeff Bezos $100, they won't change their consumption at all, which is just what we're saying.
Exactly.
Whereas a homeless person will change it a lot. And so an interesting implication there, if you go with the status quo you're talking about, is that like we are presumably giving wealthier people a lot more money than we're giving poorer people through monetary policy, like through this easy credit. So it's presumably quite skewed because it's overcoming some of this. Maybe not for Jeff Bezos or Bill Gates, but like at least for other wealthier people that aren't quite as wealthy, it's overcoming some of this effect of where wealthy people don't spend as much. So that's kind of interesting.
Right. Yeah, that's exactly right. So there's two effects here. One is the distributional effect and the fact that the economy is underproducing, and some people just don't have access to the economic output. And then there's this financial instability effect, which is the fact that you're doing it through the financial markets, through the banking sector, means that the government is saying, hey, private financial sector, we want you to be the source of people's money, of the economy's money, and you're going to do that by creating more and more private debt that gets more brittle over time. And really, the Fed has to accommodate this expansion of private debt because they have to, there has to be this flow of spending in order for the economy to work. They can't just decide not to do it. So the Fed doesn't really have a choice. The fiscal authority does. They could, if they paid out a basic income, now that forces the Fed to tighten, or it allows the Fed to tighten, because the Fed really does want to tighten. They don't want too much expansion of private credit, but their hands are really tied. And this is part of the issue. If you really want the central bank to be responsible for financial stability, for maintaining stability in the banking sector, but you also want them to maintain the stable price level, there's a conflict there, because in order to maintain a stable price level, they might have to make credit easier than what would be compatible with a stable financial sector. So the fiscal authority can then come in and say, "Oh, okay, we'll do our part. We'll push money into the system until the central bank can get to the point where monetary policy is tight enough that it doesn't have this effect of an unstable expansion of credit, that eventually collapses, that kind of thing."
I guess I also wanted to ask, when the Fed is stabilizing prices through making credit easier, basically, or cheaper, I guess, are they thinking about it? Like, are they aware that this is steepening the demand curve and that's how the prices are being propped up? Is this something that's understood consciously by at least some people who are involved in doing it? Or is it kind of like, oh, by trial and error, we have I'll have three options. My second option is well, we just see that this happens, like prices go up when we do this. Or third option is do they have a totally different theory that you would say is wrong or something like that, or why it works?
So I'd say all of the above. I would say the main thing, if you're a practitioner, is that you're trying to hit your goal, and you know that if you lower interest rates a little bit, that's going to give you a nudge of inflation. And then, that's the main thing that they're operating on. Okay, we know we have this goal. We know how to hit it. We know how to hit this target, right?
Like we've learned from experience for whatever reason.
Yeah. And then the rest is, okay, now what's the theory behind how all of this works? Most of the mainstream stuff you hear about, there's this idea that, if you're starting to see inflationary pressure, then, maybe the economy is overheated and you're actually using up, all of your resources, or you're getting towards the limit of your economy's productive capacity. I think that's wrong. And that's what the diagram shows, right? Because what you're doing is you're steepening that demand curve. You're not pushing it out and allowing the economy to produce at full output. So Eddie says the Fed sees the economy as a monolith and it can only put money in or out through debt markets, which reaches the wealthy. And that's why basic income should become the primary route of money creation, so the distribution is more healthy and optimal. Yeah, and this comes back to the idea that there's money in the economy and it's just kind of circulating around, facilitating things. If you're thinking about it that way, then it shouldn't really matter how the money is added, right? Because it's just either in the economy or it's not. I think a more useful perspective on this is to really pay attention to the slice of the economy that we care about, which is the flow of money from consumers to producers and the flow of goods and services going in the opposite direction. Once you isolate that slice, then you can start to change what's happening outside the slice. You can say like, maybe instead of forcing money to kind of cycle back through the labor market, you can have money coming in through basic income, and that can be the source of money for consumers, that kind of thing. So it's about really that slice, and then the patterns of the flow of money and then the opposite flow of goods and services within that slice. And then you can manipulate what's going on outside that slice to get the optimal patterns within the slice.
Yeah, that's interesting. I guess so what you were saying suggests a wrong theory. Like if they think that the economy is at capacity when you start to see inflation, presumably they're not thinking about the demand curve effect that you're talking about. Maybe some people are also thinking about that, but it would suggest that they aren't, right? Because that would be at least a question. It's like, are we getting to capacity, or do we need to flatten the demand curve? Should be a question that you would then raise and maybe try something else with a different distribution or something.
Yes. Yeah, it does indicate that. And then the other big assumption that is often not questioned in macroeconomics is the idea that the source of consumers' income, the source of their purchasing power is wages. So it has to come through the labor market. So there's just an assumption that that's kind of like the normal way that things happen. So if you want people to have more access to the economy's output, you better make sure that they have enough jobs and high enough wages and that kind of thing. So if you have a basic income kind of in your mind as a policy option, then that allows you to kind of unbundle the jobs from people's incomes. And then you can have not only the financial sector be more efficient, that it's only kind of funding productive investment. You're not using it to prop up demand or to boost people's incomes, that kind of thing. But the same thing for the labor market, right? Like the two are connected. We prop up the financial sector to prop up jobs. So we're distorting the labor market away from efficiency, and we're distorting the financial sector away from efficiency because we're not thinking about people getting their money in a way other than through jobs.
Yeah, and I guess just to bring things back to what we were talking about in the prior weeks. So MMT does talk about inflation as a suggestion that you're hitting a resource limit. And so you emphasized before that that's something you disagree with, and we're kind of delving into that a bit more.
Yeah, that's kind of the mainstream view. They just don't really question it, I think.
And I guess they also don't question getting your income from jobs, but I guess those two assumptions are dissociable, I think, in the sense that maybe if you convinced an MMTer that inflation was due to this demand curve effect, they'd be like, oh, great, even if we start to see inflation, we can still fund a jobs guarantee because it will reach different people and it will spread the income out. And that would be potentially correct, right? There are somewhat dissociable assumptions that you could break one without breaking the other, I think, right?
Yeah, you could use a job guarantee to do what a basic income does, to ensure that people are getting their money and you're not destabilizing the financial sector, right? Like you're paying people directly instead of having to go through the financial system, right? It's still distorting the labor market away from efficiency, but it's not distorting the financial sector away from efficiency anymore. So that's what the job guarantee gets us. It gets us halfway there. And then basic income gets us the rest of the way, where wages don't necessarily have to be connected to people's incomes anymore. Yeah.
Yeah, and there are some good points questions in the chat. So maybe I want to drive your attention to this.
So Austin says, so a steep demand curve causes inflation to kick in before the productive capacity of the economy is actually maxed out. Yeah, that's exactly right. Yeah, that's what I'm showing in the diagrams, and that's how monetary policy works. They steepen the demand curve to kind of prop up prices, to prop up kind of this distribution of consumer spending that prevents the price level from coming down. But it's not an indication that they're maxing out the productive capacity of the economy. Yeah.
Can I take a stab at the intuition, and you'll tell me where I'm going? But let's imagine that you only have, like you've often talked about, like only half of the people in the economy have money, just to like make it extreme or something, or even like 3 rich people, whatever. And there's just only so many. There are only so many things that they really want to buy. Like there are only so many apples, there are only so many cars. And the things that are in the price index, it's worth pointing out, are like mainstream items. So let's say there's only so many mainstream items. Like maybe they're willing to buy like ever more expensive paintings, but that's not in the index for inflation anyway. So of the things that are in there, like food, whatever, they're only willing to buy so much. And so if you just like keep giving them more and more money and like don't give it to the people who don't have it, just like keep giving it to them, what's going to happen is those prices are going to go up instead. Like what Alex often points out is like the companies will start competing on dimensions other than price because they have more money to spend. They only need so many things. So like they'll just be like, oh, I'm going to buy the ever more luxury apple, like the organic apple that's been prayed over by the Dalai Lama or whatever. And you see like some of this, not the Dalai Lama part, but like and like the car will be like ever more or whatever and stuff. And like it's slightly different as an item, but a lot of it is just the price is going up. And so the consumer index will show. The price index will show that the prices are rising. And that's maybe not because you're at capacity, but just because these people only want 5 apples a week, but they have more and more money. So they'll spend like more and more money on those apples. So the prices are going up. And that's true like across these different items where like, but not necessarily because we're at capacity. If you instead gave more money to people who don't have it, they would just want to buy apples, more apples. So there would be more people wanting to buy more apples at the current price. And so you just produce more apples. So I don't know if that was helpful. Maybe people are already following along, but I think that's the idea for why, you might start to see inflation even if you're not at capacity, because you just got the same people buying the same number, like sort of saturated on apples, and then they just go for like more and more expensive ones, or they're willing to pay more and more, right? Even if you don't change the apple, I guess they would be willing to pay more because they have more money. They only need so much.
Yes, that's exactly right. So Austin was asking about going over the mechanism again, and I think you just did that. So he says there's no point in increasing output and lowering prices because there's no more potential customers in the market. So that's the extreme scenario. That's where you have a chunk of people who have money, and then you have a chunk of people who just don't. No amount of lowering the prices is going to allow you to sell goods to people who just don't have money at all. So you really wouldn't want to lower prices at all. Any lowering of prices is going to eat into your profit, and you're still selling to the same people. Instead, you might even want to raise your prices if you're not going to lose the people who have money. You're going to raise prices until it's no longer profitable to do so. So that's the extreme scenario in which some people have money and others don't. And then you can kind of reconstruct maybe it's not that some people have money and others don't, but that it's just a very steep gradient, right? So instead of lowering your prices and you don't get any new customers, you're lowering your prices and you don't get enough new sales to make it profitable. And so the concept here is called price elasticity of demand. And you can look that up on Wikipedia. Here I'm talking about kind of the price elasticity of aggregate demand, which is going to depend on the distribution of purchasing power in the economy. And then the reason why monetary easy credit policy creates this skewed distribution of purchasing power is that it gives more money to the people who already have money both through asset prices and through ease of access to borrowing. Now, I should caveat here, it doesn't really matter if there's like a few ultra hyper rich billionaires way off the end of the chart. That's not where the prices are being set in the market. The prices are being set kind of at the in the middle, right? So what matters is kind of the slope of the demand curve in the middle, where the prices are actually being set. There might be separate, luxury markets with ridiculous prices, but that's a different kind of segment of the market for the Bill Gateses and the Jeff Bezoses and the things that they buy that nobody else would think to buy or would
like
ever be
space,
able to afford
for
to buy.
example, I think. One of them
yeah, like a yacht for your yacht or whatever.
Yeah, well, actually, both of those are Bezos, right?
Both of them Bezos. Yeah,
he's doing both right now.
Yeah.
Yes. I wanted to, let's see, there was a few. So I thought Neil had an interesting point about inflation for low-paying services, and I wanted to point out that, like, obviously, you're not going to produce something for cheaper than it costs to make it. So, like, if part of what it costs to make something is like the labor you have to pay for, isn't it possible, I think I'm interpreting this question correctly, isn't it possible that, like, there are some trades that end up not being made if you give people a basic income, because people are like, I'm not going to work for that cheap anymore, and like now that would, like, now the sort of base price of, I don't know, like restaurant service or something goes up. So like for certain service industries, could we see things like that? Maybe even if the aggregate price level is the same.
You're getting this from Neil's comment?
I may be misinterpreting. He said, in the present environment, we may have some inflation for low-paying services. I was inferring he meant if we added a basic income, some currently low-paying services might go up in price. But maybe I'm like way off. I'm sorry, Neil, if I am. Please correct me. I might have just made that up.
Yeah, I can see what you're saying. When you completely change the distribution of things, some prices are going to go up and some prices are going to go down. And in particular, if you change people's access to money, that's going to change the incentive to work, and some labor prices are going to go up and some labor prices are going to go down. So those are inputs to various different things. All of that is true. When we're talking in aggregates, we're not as concerned about that, but it's certainly true. Austin says, wouldn't competition between Apple producers limit price rising, even if there is a limited market of well-off consumers? If you assume perfectly competitive markets, yes. My default assumption is that there's no competition, so everyone's kind of setting monopoly prices. That's also not what happens in the real world. But as Bethany pointed out, as demand becomes more inelastic, businesses start to compete on dimensions other than price, like product differentiation and gold flakes or whatever that kind of stuff. So you start to see it's still a kind of competition, but it's not price competition anymore. So that's kind of one of the main ways that businesses get around competing on price is they compete on other dimensions. It doesn't even have to require collusion. It's just like, oh, there's a market with people who have a lot of money and we want to capture it, as much of it as possible. We don't want to lower our prices, so we're going to do something special that gets people to buy from us. It could be advertising or whatever, right?
I think what's tricky about this is, like, all of it is kind of like an issue of a matter of degree. Sort of like the more you move in this direction, the more this happens. So it's not like they wouldn't be competing on price at all, but they're just like shifting. The more you have like the same wealthy people are just getting more and more money, or upper middle class or whatever, you're kind of shifting more towards keeping prices high and differentiating on other things. Whereas the more you have a bunch of people who are like, okay, I'm only buying an Apple if it's under $1 or whatever, like you're going to see more competition based on price, right? And it's just kind of like a gradient in between those things, as opposed to saying that we actually have to assume there's a complete monopoly or something like that, right? Yeah,
I mean, I like to start by assuming there's a complete monopoly, because I think that's closer to what you see in the market in terms of how prices work. Because if there's really inelastic demand, people are going to find ways to get around competing on price. Now, of course, competition does have some effect, so it just kind of like reduces the all of the stuff that I'm talking about by some factor, but it's not 100%. And this is why I like to, people talk about, demand pull inflation or cost push inflation. The type of inflation that central banks generate, I like to call it anti-competitive inflation, because what it's doing is it's making demand less elastic, and it's creating an incentive for firms not to compete with each other on price.
Yeah, that's interesting. Yeah, and I guess I would just point out, like, as you said, that we don't have to take a particular stance on there being no competition versus some competition on price, et cetera, because you're kind of isolating or highlighting the particular component that comes from demand being elastic or non-elastic, and like how the distribution of money is working. Right?
Yeah, as long as we acknowledge that that competition is never going to be perfect, the central bank is going to be able to do this. The closer they are to perfect competition, the more the central bank is, the harder the central bank is going to have to work to steepen the demand curve. Yeah. Is one way to put it.
I want to make sure we get into financial stability too. Now, there are other good questions in the chat, but just to kind of raise that again, I think it's interesting that you have, again, to kind of draw it back to last week, we had we have an MMT's view of how to deal with financial stability, which is to offer like a counter cyclical, which is to offer a jobs guarantee, which they think will kind of push back against the cycles.
That's not about financial stability.
Oh, you wouldn't call it that?
Well, I wouldn't call it. I would say that that's to push back against the business cycle. I would say, yeah, the business cycle is caused by financial stability. I was going to
elaborate, and I think so let me elaborate, because I think I'm going to make the same point. So what I was going to say is they're taking the boom bust of the financial sector for granted. They're saying like that's going to be there, and then like how can we buffer its consequences for people? Or is maybe one way they would talk about it. And like how you buffer it is that you have and maybe buffer it spiraling downward more too by like demand continuing to fall in a recession or something like this. You do this by like having a jobs guarantee, where you're basically pumping more money into the economy through jobs when things are bad, and then that helps to bounce back. And then you do the opposite, because people naturally leave those jobs because they're not that great or whatever when things are good, and so on. So that's their view. And I guess just to contrast it, which I'm sure you're going to, you have a view of basic income kind of softening quite a bit the ups and downs in the first place. So that's kind of an alternative that you think basic income would provide.
It's not that basic income, I wouldn't frame it as basic income softening the ups and downs. I would frame it as basic income is what you do instead of doing the thing that causes the ups and downs, right? We're doing this overly expansionary monetary policy to prop up consumer spending because we don't have a basic income, right? So it's that the absence of the basic income is causing kind of this business cycle. And the business cycle is, it does have these features of financial instability that, you can have a recession that's not due to financial instability if something happens to your real resources, right? But that's not what happened in, early 1930s. That's not what happened in 2008. It was, conditions in the banking sector and the financial sector that caused problems for the real economy.
That's what happened in the pandemic. But it's interesting, just as a side note, that we were like presumably pretty far from capacity. So we were actually like not really noticed. I mean, like we basically could give people as much money as we gave them and it didn't cause a problem. And we probably could have given them more. Like even though we took a hit to real resources, just as a contrast to some of those.
So actually, so the pandemic, the fact that we were able to do stimulus in response to the pandemic when we were shutting down a lot of the economy, yeah, you're right. That's evidence that we weren't at capacity before. If you're living in a basic income world and you're maxing out the economy and then you have to shrink it down and shut down large parts of it, everyone's going to be poorer at that point. You can't. The response is not to stimulate the economy. The fact that we could even do that was a sign that we were doing something wrong.
That's what I'm saying.
Beforehand.
But I wanted also to say like the reason. Oh, sorry. Did you want to say something else?
Yeah, I just want to actually talk about financial instability more. If possible.
Yeah.
So in terms of, so there's an economist by the name of Hyman Minsky who had something called the financial instability hypothesis. And his, he looked at the economy as, primarily from a financial perspective and a banking perspective. And everybody, all the firms, all the people, everybody in the economy has, promised cash flows that are coming in at certain times. That those, their assets represent flows of money coming in at some time in the future, and then they have commitments that they have to make. These are their liabilities, and then in order to make everything go, they have to line up their cash inflows with their cash outflows to be able to make all their payments. So it's this vast interconnected system. But then as they get more comfortable and they are able to continue to make their commitments and everything, more and more commitments build up, and the whole system keeps on working. But what you don't see behind the scenes is that the dominoes are getting closer together. Is that everything is still working. Everything is still working. At the beginning, when only a few people are borrowing, then a domino falls over and all the other dominoes are fine. Once all the dominoes get closer together, there's default, it causes a chain reaction. So that's the financial instability. And Minsky said that this was a natural feature of capitalism, or what he called financial capitalism, or he had these various different names for things. And my contention is that this doesn't have to happen in a basic income world. So Minsky's solution, what he wanted to have happen to kind of prevent this, is he wanted businesses to be more funded by equity rather than debt. So the way to think about, so equity is like stocks, right? So the way to think about on a balance sheet, the way to think about equity is that you have a certain amount of assets and you have a certain amount of liabilities. Some of your assets are going to be offset by liabilities, and then you have extra assets. That's your equity. It's the assets that are not offset by any liabilities. So if one of your assets ends up not being worth anything, or the promised cash flows don't come in and you have to write it down or something like that, then you can take one of your extra assets and cover it that way. So you have this capital buffer that can absorb losses in your assets. So that's so what he wanted was for all the businesses to have more of this capital buffer, because instead of borrowing or in order to fund their investments, they just fund it with money they already have. So when he says he wants businesses to fund themselves using equity, what he's saying is he wants businesses to invest with money they already have, rather than borrowing in order to invest, and that creates a more stable environment. But then the question is, how do you make that happen? And if you have a basic income where people have more money to start with and don't need to borrow as much, then you're in a situation where businesses can fund themselves with money they already have, or more so. Shareholders can buy in. It creates a situation where there's less private debt. Obviously, you have to tighten credit conditions as well. Otherwise, people will be like, oh, but we can also, get debt, and we just want to max out everything, right? So you have to have this tightening of monetary policy at the same time that you're issuing the basic income into the economy. Does that make sense?
I think so. Yeah.
So yeah. So the idea is that if you have businesses that are funded by money you already have, and the business fails, okay, that, the owners of the business take a loss, but there's no contagion throughout the system. Even in our real world today, a lot of equity is funded by debt as well. So people borrow in order to buy stocks. So, it's still all interconnected. But if you look at the aggregate and you reduce the amount of private debt, and you kind of shift in general, like the character of the whole economy shifts more towards equity. Businesses are financing their own investments based on the money that they have, or the money that they're already making in their current business, rather than going out and borrowing in the money markets or the capital markets. Then you have kind of a more robust system, and there's no reason why that system should tend to get more fragile over time, because you can tighten credit conditions as much as you want, as long as you ensure with the basic income that there's enough money out there to compensate.
This is something I had a question about before. When I said soften the business cycle, I was wondering, you obviously want some investment happening just in the productive economy, and so wouldn't, as a byproduct, you also get gentler ups and downs? And if not, why not? Maybe.
Yeah, and the answer, when I was the dominoes metaphor, right? If you keep the dominoes far enough apart, one falls over, doesn't cause anything else to happen, right? So you can still have kind of a stable level of investment in the private financial sector, and businesses can fail, but it doesn't create this macroeconomic kind of shift. So there's suddenly a deleveraging of credit, throughout the economy or something like that. You just won't have that. Because you've removed the fragility, you've removed the underlying instability.
I'm confused as to why there's kind of like a qualitative difference, and I'm also confused as to why sort of the right level of credit in the system for investment and so on would line up with that qualitative difference, where the dominoes are far enough apart not to affect each other. I guess I'm struggling to see.
Yeah, so I guess the question you're asking is, well, maybe we want more debt-based investment than you would get by keeping the dominoes at safe distances.
Yeah, how do you know you wouldn't want that? I don't know, right? Yeah.
Well, I mean, I guess the simple answer is that you can replace the the debt based investment with equity based investment. So you give people more money. So it's not that the investment isn't happening anymore. It's that it's being funded by money that people already have.
So is equity based investment, maybe you said this before, I'm sorry if I missed it. Like if I buy a stock, is that equity based investment?
Yeah. Yeah, so you're buying you're becoming an owner of the business. So you're putting money in. Right. Now you live and die with the business, right? The business doesn't owe a debt to you, but you own a share of it. So theoretically, you own some of the profits that come into that business.
So like me getting a mortgage, that's a debt-based investment. I'm like investing in a house, but I had to take out a bunch of debt to do it. But like me. Yeah. Me buying a whole bunch of stocks with my excess money is
or you buying a house outright, right? That's just money you already have, and then you can sell the house later, and
the house isn't a great example because it's not investing in like a company developing. Like I guess a company seeking a loan would be a good example of that. They have to pay it back.
Yeah. And debt-based financing is often for shorter-term stuff. Equity is like, oh, you're gonna, these shares exist for the entire lifetime of the company, right? So you pull the money in, and then it's there, and that kind of thing. So there are some important differences, but I don't see any reason why we would need to have so much debt in the economy, so much private debt in the economy that you'd get this instability in the financial sector. Yeah. It just doesn't like. Yeah. Go ahead.
I was just going to say, I think a lot of us, at least myself, like I'm so, the kinds of these investment things that come to mind are so basic that it's probably hard for me to have an intuition for how much complex interconnected debt is actually happening in the economic sector. Like how much people are kind of like borrowing from this person to like bet on this other thing and then borrowing again to bet on this. I don't know, like it's just crazy. And most of us, I think, don't really like have a picture of it. Maybe other people in this meeting do, but I don't. Yeah. So I think it can be hard to see like how things get brittle and why, without knowing about some of those things that are like kind of just a small number of people doing it, but it's a huge amount of money.
Yeah, it's a lot, and it's a lot of businesses, right, are in business because they can borrow. The money's cheap, and that's how they're financing themselves. And even in a world where you're not one of those businesses, if your customers are being financed indirectly through debt, and you lose your customers, then maybe you go out of business too, because your customers no longer have a source of money, and you're not making any sales anymore. Right. So, so it's all connected. Everybody's balance sheets are connected. So you have to kind of change the tone of the overall macro economy, of the overall financial system, in order to make it more robust. And basic income can do that, right? Basic income combined with monetary tightening.
And I think Austin's point here is relevant. He's also saying like it's mixed up in the real world. People borrow to buy stocks, so that would be an example of like using the debt to invest and so on.
Yeah, and convertible notes. Yep. And he says that he thinks inflated stocks are also a product of easy money. Yeah, and I often bring this up, but you can ask the question, what happens to the stock market? What happens to the various financial markets when you introduce the basic income? What does that transition look like? And then what does the world look like after you already have the basic income? What is that new state of the world? So certainly when you're introducing a basic income, since you're tightening monetary conditions, you're tightening credit conditions, that's probably going to cause downward pressure on stock prices. But then once you've gone through that bumpy transition, all of that, you're in your world with basic income, you can imagine that there's a lot less borrowing by businesses, and a lot more businesses just being funded by their owners, whether that's, a public company that's issuing shares or whatever. It's equity financing. It's you're investing with money that you already have, essentially.
Yeah, that makes sense. Because you're also giving people more money in this other form, like with basic income.
Yeah, there's just more money out there. Instead of asking the private financial sector to print our money through lending and borrowing, right? You're just doing it directly. What you're doing is you're replacing private sector, an expansion of private debt with an expansion of public debt. You're expanding the public money, which is the liability of the government and the central bank, of course. But now you've got one issuer of all of these things, and it's not this delicate, brittle web of different actors that are all depending on cash flows from each other, right? It's one, you've consolidated onto one balance sheet. There's one debtor whose liabilities are everyone else's money. You're taking advantage of this hierarchy. Right? It's like in computer networks, it's the difference between, complicated, brittle, peer-to-peer networks where everyone has to send packets to each other, and then like a client-server thing, right? Which is just much more stable and robust. The difference, of course, is you have a single point of failure, but you already have, in terms of the monetary standard, you already have the single point of failure anyway. If the Fed doesn't manage the currency properly, it all falls apart, even with all this private debt. But yeah,
it's still based on the dollar. So.
It's all all the debt is dollar denominated anyway. So you're just saying, oh well, we have this hierarchical structure, and we can use the liabilities of the Fed directly as our money instead of having to generate all the money through the liabilities of the financial sector, issuing liabilities of the financial sector. Yeah.
Do you know how it evolved that? I guess this became the way that we kind of buffered crises.
Oh yeah, that's a really good question. I think Hyman Minsky would have argued that it was an accident of history, that things could have gone one way and they went another way. But it's kind of this way everywhere. So that's an interesting question. Why is it this way everywhere? I think Minsky, interestingly enough, he generally supported the idea of balanced government budgets, which I think, if you're doing that prevents you from kind of crowding out enough of the private debt with your public debt.
Right.
And he wasn't talking about basic income either, that kind of thing. So he did have this vision of, well, what if, instead of everyone borrowing, they're funding their businesses with money they already have, they're funding via equity instead. I don't know that he had a clear picture of how to get there.
Yeah.
But basic income can get us there.
It's interesting because I was going to say, it's sort of not at all obvious that you're printing money if you do it in the private sector, because there's this idea that people have to pay it back and things like that.
Right. But then the reality is, of course, that the private sector debt just keeps expanding and expanding. It's just this heterogeneous, unstable thing, right? Instead of the private sector debt continually expanding and expanding, you can have the public sector debt continually expanding and expanding, and that's a very stable mechanism.
And I guess I was thinking, during the Depression in the United States, we must have run a deficit or something to fund all the jobs programs and other things. That was a version of creating public money, right? Creating more public money to deal with the
and certainly during wars, right? During World War II.
I was thinking of the Depression because it was an attempt to stabilize things, get out of deflation.
Yeah. I think a lot of times people are like, oh, we need to run deficits now. But there are these important, budget constraints that are going to come back later, and we need to worry about them later. But now is not the time, or something like that.
Yeah. And that's the same rhetoric recently during the pandemic too. We also expanded the deficit to just spend directly into the economy.
Yes, that's right. Yep. So was there any other points I wanted to make about basic income and financial instability? I think, it does come back to this idea of what is the problem that basic income solves. It's how people get their money. And if that's broken, then all these other things break in the economy. So sometimes you hear critics of basic income saying, hey, you're, trying to provide a simple solution to a host of really complicated problems that you don't understand. I would say that, well, when the way we get people their money is broken, that's going to cause a lot of complicated problems that we don't understand. And we don't have to understand them to know how to fix them. Maybe we don't know which problems are the problems that actually are going to be fixed by basic income, but we can find out, right, once we fix this problem of how we get people their money. Yeah. And financial instability, it feels to me like, is certainly one of them. We don't need to be forcing the economy to get its money through the private financial sector. It's just not necessary.
Yeah, and it's pretty exciting to have a supposed way to flatten out or end the business cycle. That's a pretty inspiring thing on its own. And meanwhile, it has so many other benefits.
Yeah, it's kind of like the holy grail of, or one of the holy grails of macroeconomic policy, one that I actually agree with. Another one of the holy grails of macroeconomic policy is full employment, which I don't agree with.
That's true.
But yeah, you know, people have been wondering how to do this for a long time. And it's, you know, and I think Hyman Minsky was kind of onto something that, you know, he recognized that as long as you are doing everything through debt, and there are these incentives to kind of keep building and building more debt, the financial system is going to become more and more brittle or incoherent over time, and then it gets to the point where anything could kind of trigger a collapse. Just knock over one of the dominoes, the rest of them fall, and it doesn't have to be that way. So if you, yeah, it doesn't have to be that way. Not with the basic income. All right, so we're at the end. I'm going to be giving a talk on this next week, a shorter talk that's maybe more concise than what I said here, and I'm going to be presenting a paper as well. That's going to be next Friday. Next Wednesday, we have Boston Basic Income again, obviously, because we do it every Wednesday. And we're going to have Carl Weiderquist on, and he's going to be talking about lessons from the Alaska Permanent Fund dividend. So tune in for that one.
Thanks so much, Alex.
Yep.